Everyone talks about dollar cost averaging into the TQQQ, but what's the best strategy to do this? No one really agrees. Some people say that you should only DCA when the TQQQ is above the 200 moving average and sell everything if it goes below the 200 MA. They call this trend following. Others say that you should only DCA when it's below the 200 moving average. Which one is correct? So in this video, I'm going to give you the results, the backtesting, and at the end of this video, you will know which strategy will turn you into a millionaire. Alright, let's get into it. Alright guys, so I backtested two different strategies, strategy A and strategy B. Strategy A is a trend following strategy. You basically buy when TQQQ is above the 200 moving average, right? You only DCA when it's above the 200 MA. And in both strategies, we allocate initial capital $1,000 and then we DCA every month $150. So in strategy A, you buy only when it's above the 200 MA and you sell everything when the price goes below the 200 MA. So this will protect you from large drawdowns. So once the price goes below the 200 MA, you are in cash. And then you re-enter the market, you buy again when the TQQQ crosses again the 200 MA. So basically it's don't catch falling knives kind of strategy, and you just buy when the trend is very positive. This strategy was popularized by this paper that you can see here on the screen, Leverage for the Long Run. Actually, it's a quite good paper, and in this paper they demonstrate that usually when prices are below the 200 MA, the market is much more volatile, and this strategy will protect you from very large drawdowns, as you will see. And one of the things that I usually like to show from this paper, piece of information, is that if you have used some leverage on the S&P 500 from 1928 until 2015, you'll have these results. So basically, if you have used a 2x leverage on the S&P 500 for this almost 100-year period, you will have 86 times the returns of the non-leveraged version, and 3x leverage will give you 290 times the returns of the 1x leverage, the non-leveraged version. Pretty interesting piece of information, right? Alright, now let's talk about the strategy B. Strategy B is the discount accumulator. It's a strategy where you buy only below the 200 MA. So we start also with the initial $1,000 with dollar cost average $150 every month, and you buy only when the prices go below the 200 MA. So when the market is dipping is when you start deploying that cash that you have been accumulating every month, those $150. And basically, we never sell it. We hold it through the entire period, no matter if the market is crashing or is going up. So this is a buy the dip logic, but you will suffer those big drawdowns. So one of these strategies return 2,100, the other 3,600. Which one do you think returned the most? Let me know in the comment section before I move forward with the rest of the video. And by the way, guys, I talk about these and many more strategies in my 5-hour-long leverage ETF course, which you can find in the Henrique Wealth Academy. You can find the link in the description of the video. We have a 7-day free trial. If you want to stay, you can stay. If you don't want to stay, you can cancel. No questions asked, okay? But I would love to see you there because we have so much information. Everyone is talking about leverage ETFs, including me, and we share very interesting strategies. All right, and the first strategy that we have here, let's jump on the screen. And the first strategy that we have here is the strategy where you buy only above the SMA, the simple moving average 200. 200, why 200? This is a very common moving average that is used in the market to tell you whether you are in a bull market or bear market. So usually we consider that we are in a bull market when the prices are above the 200 MA, and in a bear market when they're below. That's basically how it works. So in this 15-year period, we have invested a total of $28,000, and now we will have $635,000. Not bad at all. Almost 2,200%, 2,145% return. Pretty good. And the max drawdown would have been 49%. And as you can see here, across the chart, for example, in last year, in around April, there was a drawdown, right? Prices went below the 200 MA. 200 MA is basically the orange that you can see here. and basically it goes into cash. So this line, the blue line, is your equity, your investment. And every time it dips below the 200 MA, you turn into cash. And the orange line at the bottom is cash. And you can see here that, for example, during the 2022 bear market, this would have been a very good thing to protect you from volatility and protect you from very large drawdowns. Because in 2022 you had this very extended bear market. It was very, very painful for the TQQQ holders, because TQQQ during this period in 2022 went down by 80%. But as you can see here, as soon as it starts to go down a bit, you see it into cash because it went below the 200 MA. You have cash during this entire period. And then when the prices go again above the 200 MA, you get back into the market. And that's why you have here a 49% drawdown, not an 80% or 79% drawdown. So this is the strategy where you are long only when the prices are above the 200 MA. Okay, what about the strategy where you are buying the dip? You do the opposite, almost the opposite. So you buy when the prices are below the 200 MA. In the meantime, you just accumulate cash. All right, so this strategy will be very different. So investing in DCA, investing your money only when the markets are below the 200 MA and average selling. So you are just buying the dip, you dollar cost average when the markets are bearish. It will have transformed the same $28,000 into over $1 million. So that's a 2,593% return. Wow, this is actually very impressive. But look at this, max drawdown 81%. Which strategy would you choose, right, by looking at this? Well, I don't know. Let me go back here. And basically in this strategy, you are investing all the time. So in this strategy, as you can see here, you deploy your capital, your cash is accumulating, and once it goes below the 200 MA, right, you buy, okay? So you have here different situations where this happens. You accumulate cash here, goes below the 200 MA, you buy, and so on. So it's just a buy the dip strategy. And so the verdict basically is that buying the dip, in this case, dollar cost averaging when the markets are crashing, would have been the best strategy if you are focusing on return on capital. If you focus on managing volatility and protecting yourself from drawdowns, then the best strategy is actually to sell when the markets go below the 200 MA. So which one is right for you? Well, depends on your risk profile. I talk about this every single day in my Henrique Wealth Academy. Check the link in the description. But the one that you should choose, it should really be according to your personality and your risk appetite. So if you sell when the market goes below the 200 MA, you protect yourself from very large drawdowns. You cut some of the volatility, but you are also going to cut some of the gains. Remember what I always say, volatility is the price you pay for performance. If you are focused not on just controlling volatility, you can hold it for the very long periods, and you have some cash on the side to buy the dip, then buying below the 200 MA and holding it all the way will perform much better. I sometimes do a mix. You can check my other videos, because what I actually really like to do, and I advise most people to do in my community, is a mix of dollar cost averaging every single month and buying the dip every time the markets go down by X%. By the way, guys, I'm preparing a series of videos where I'm going to be talking about leverage ETF strategies. The next few videos will be about rebalancing strategies, different strategies that you can use to improve the performance of your leverage ETF portfolio and also to reduce the risk. Because basically there are two forms of an investor beating the market. You can beat the market by having better returns, or you can beat the market by having kind of similar returns, but with less risk, less volatility. And I really love when we combine both. What if we combine less volatility and better performance. This is what I call better risk-adjusted returns. Alright guys, if you enjoyed this video, give it a like and subscribe, and let me know in the comments if you have any questions, and I'll see you again soon. Bye!